All right, you're now tuned in to tonight's royalty movement training. Topic of discussion is how the IRS can help you build your credit while also making you wealthy, plus some crypto talk. So you want to stick around all the way to the end, have your pen and pad handy, screenshot ready, and take notes even up after you take the screenshot. And of course, you got yours truly, the one and only Mr.
and Mrs.
Smith, the host of tonight's training. And we got a good one. It's an action pack, and it really just brings it all full circle. This is the type of conversation that the wealthy people have. I'm going to close out my camera so you can definitely make sure you're looking at the screen primarily and not looking at me, just in case I make a funny face. I want you to be focused on the information, not on the facial expression. So that being said, let me turn off this camera and move this thing out of the way temporarily. All right, perfect. Now, I know the title might have threw you off just a little bit when I said how the IRS can help you build your credit, make you wealthy, and then a little crypto talk. Because a lot of times when people think about the IRS, they think about them being the enemy. A lot of times when people think about the IRS, they think about them wanting to take their money. But did you know, and this is directly coming from me, did you know that the IRS actually provides the playbook or provides the most information of how to keep more of your tax dollars? That comes from the IRS. So if they were only the bad guy, then they wouldn't teach you how to get some of your money back. They wouldn't teach you how to keep more of your hard-earned money. They wouldn't teach you how to lower your tax liability so that money can come back into your household. And ultimately, in my econ, that money should be going somewhere else, such as debt elimination, which helps to boost your credit, such as investing, which helps to increase your wealth. See, you want to leverage the IRS so that you can use what they have available to you to your advantage. And now when you use that to advantage, you by default become wealthy. You see, don't always look at somebody as the bad guy just because that's what they're portrayed to be. You got to, take a step back and be able to cast your own judgment. And what we're going to talk about tonight is information that has come from the IRS website centered around tax deductions. And if you understand tax deductions can help you better your credit because a part of income shifting is increasing your cash flow. One of the ways we help you to increase your cash flow is through tax minimization. So it's important for you to understand this. And if you understand taxes, you'll understand that your biggest bill that you pay in life is not your mortgage, it's not your rent, it's not your auto loans, it's taxes. So you got to wrap your mind around lowering your tax liability. If not, it's going to be disastrous for your wealth. You know how certain foods are disastrous for your health. You not understanding how to legally lower your tax liability is going to be disastrous for your wealth. You might want to write that down. Why is that important? Because if taxes is your biggest expense, more than your mortgage, rent, auto loans, and many amounts of money that you might spend with certain companies, then if it's a legal way to lower that and pay less in it, why not do it? It only makes sense to do it. Now, you want to do it the right way. You want to be strategic with it. We're not trying to get anybody in trouble. And just on the forefront, just to kind of throw out this disclaimer, this is not considered legal advice. This is not, I'm not a tax advisor or tax strategist, so to speak, or enrolled agent, EA, that's the word I was looking for. I'm not any of that. However, I'm just giving you what has worked for me. And this information has come from people who are tax strategists, tax advisors, enrolled agents, and sometimes even tax attorneys. So this information comes from them, but I'm not either of them. However, I'm sharing this just for educational purposes only and strategy purposes only. And this information that I'm about to share with you now is known as the Common Tax Deductions. You see, when you got involved in my econ, you positioned yourself to be a self-employed or a sole proprietorship business owner. What does that mean? That means that you can start to make as much money as you deem due to the fact that my econ has no salary cap. But what that also means is that you can position yourself to legally qualify for some of the tax deductions that I'm about to share with you. Now, I will say this, it's over 400 tax deductions that are available to you. However, all you need is a strong amount. You don't have to overdo it. You just need a strong amount that's applicable to you and the industry that you're in. For us, we do a lot of online marketing, education, and things centered around affiliates, so to speak. So that industry is wide open, and it opens up doors of how many things you're able to write off, which we'll go over some of those things here now. So these are just some of the common tax deductions, about 10, give or take, that you'll be able to benefit from. And this is important because if you want to increase your cash flow as much as possible, then you need to understand these tax deductions, because it's going to help you better your credit if you have more cash flow. It's also going to help you build wealth if you have more cash flow. But I want to stress this on the front end. In order to qualify for tax deductions, you must be in motion, meaning doing something that allows you to be represented as someone who is in pursuit of a profit. Basically, in pursuit of the profit basically means you're trying to get some income weekly deposits. So as long as you're trying to get some income weekly deposits, sharing the information, following up with people, doing content online, which is very well accepted now. At one point, it was tough. You better believe we understand, because we remember people thinking it was odd to promote your business on Facebook. Now, if you're not promoting your business on social media, you might be out of business. So now we're in the day and age where, as long as you're doing certain things in pursuit of making money, in pursuit of getting some income weekly deposits, guess what? It helps you to qualify for tax deductions in the sense of part of your phone bill, tax deductible, part of your internet, tax deductible. And the more business you do, the bigger the percentage. So we do so much business on our phone, we really can write off 100% of our phone bill due to us using our phone for business almost 100% of the time. So that's why it's important. So you don't want to shy away from doing the business or doing something that can get you some weekly deposits, because if you shy away from that and just say, nah, I just don't want to do the business, which the business side is optional. However, I will be the first to tell you that if you just want to push the business off for now, you may lose or leave about $12,000 minimum on the table in the form of tax deduction by not having a business. However, you can still build wealth using our strategies, because that's what income shifting is. So that being said, let's dive in. All right. So this is the common tax deductions, and this is the quick info packet. This is available inside of the My Econ back office, so you can definitely get access to it. And I'm gonna zone in on a couple of spots. Now, from the beginning, what I want you to make note of, and this is just a self note, a note to self. What I want you to make note of is that you're not trying to memorize these laws. You're not trying to get in the habit of knowing every IRS update, law, things of that nature. Your key role in this process to legally minimize your taxes as much as possible is going to boil down to two words. And I want somebody to type this in the chat, or everybody who's listening that's in a position to do so, type this in the chat. It's going to boil down to these two words: record keeping. That's it. Record keeping. So if you know some of the things that are likely to be tax deductible, you want to record it in your phone, in the app, in the cash flow manager. And I'll show you a glimpse of how that looks. You want to record that to your phone. Why? Because all you want to do is be keeping the records. At the end of the year, the beginning of the year, when it's time to file, you want to be able to print out the spreadsheet, because you've been keeping your records, taking pictures of your receipts. You want to be able to pass that in to a tax specialist who understands the tax law as it relates to home-based businesses. If they're not familiar with home-based business deductions, then you may want to consider hiring another tax specialist. Why? Because if they understand tax or the tax advantages of a home-based business, now when you turn in your information and you're writing off a percentage of your phone, writing off certain meals and entertainment, writing off certain travel, writing off certain mileage, they're not new to it. In fact, they may say, okay, you got all these deductions that look good. What about this? They may tell you about some things that you didn't know you can write off, and it puts more money into your pockets. So this is a way to keep more of your money and increase your tax liability, but it all boils down to record keeping. Type that in the chat. So that being said, what we want to do is just be good at keeping the records and keep as much of it as we can. So that way we're in position. At the end of the year, we're not worried about what the tax laws are. We're in position. All right, so I'm just going to hit on a couple of spots because I don't want you to try to memorize this, but this is just a list of some of the common tax deductions right here in this box. Number one, transportation, dealing with the car and truck expenses, travel, meals and entertainment, interest on certain things, wages, we'll dive into that a little deeper, home office expenses, some gifts, depreciation, insurance, record keeping software if you're paying for it, other expenses, and qualified business income. So these are just some of the common tax deductions that many people will qualify for. And I'm sure most people spend money on meals, spend money on some form of travel, spend money on some form of transportation. And because of it, those are some key areas that you can be writing off as a tax deduction in order to maximize your take-home pay or your cash flow. Now, the first one they got on the list in red circle, and like I said, I'm not going to get too specific. I don't want this to be too complex. I just want you to understand what they are so you can get in the habit of logging these receipts. For example, if you know you want to share the My Econ business, one of the first things you need to write off is your enrollment fee. That $39.95 membership is tax deductible if you're building this or sharing this as a business in pursuit of making a profit, aka in pursuit of getting some My Econ weekly deposits. Here's what they had to say about transportation. They said this chapter discusses expenses you can deduct for your business transportation. And then I'm gonna skip down. And it says traveling away from home. And it says transportation expenses include the ordinary and necessary costs of all of the following: getting from one workplace to another in the course of your business or profession when you are traveling within the city or general area that is your tax home. And then they got ways that you can elaborate and get a better understanding of it. Then it goes on to say visiting clients or customers, going to a business meeting away from your regular workplace, getting from your home to a temporary workplace where you have one or more regular places of work. These temporary workplaces can be either within the area of your tax home or outside that area. Transportation expenses don't include expenses you have while traveling away from home overnight. Those expenses are travel expenses. So basically, they're not saying if you're traveling away from home that you can't write it off. It just falls into a different category. It goes into travel. You're still able to write those things off. And a key nugget is when you're traveling, when you're driving, when you're going places, to make sure you're working your business. I don't care if you get some business cards and you're passing them out. I don't care if you meet with somebody that you were going to meet with and you discuss your business or how the income shifting strategy or the income shifting membership is helping you better your credit, better your cash flow. Naturally, that's going to make a person say, hey, how can I do that? I want to do that as well. That counts as you working your business. Now you were doing something you were going to do anyway, but you positioned yourself to possibly have it written off as a tax deduction. And as you record it, when you get with your tax specialist, they'll let you know what can and cannot be recorded. But the main thing you want to be doing is recording it, because those travel expenses, mileage, and all of those things add up. So here's some things about car expenses. I'm only going to hit on the red areas because I don't want to overcomplicate this. Your biggest job is to understand record keeping. That's it. Not memorizing this, just knowing that, okay, it's a certain amount of things I can deduct, dealing with my car, dealing with utilities, internet bill, phone bill, travel, meals. And I'll talk about meals a little bit more in depth because this one is probably going to blow your mind. But it's just you want to be good at keeping records, and the cash flow manager allows you to do that and take pictures of receipts in the process. So it says this about car expenses. If you use your car for business purposes, you may be able to deduct car expenses. You generally can use one of the two following methods to figure your deductible expenses. So generally you can choose one of the two, not both, but one of the two. One is standard mileage rate, and the other one is actual car expenses. So the difference is this: one is centered around the standard mileage rate, which is typically a little bit more than 50 cents per mile. So what that means is most people drive about 1,000 miles a month, give or take. I know people are driving less now than they used to, but 1,000 miles a month. So if you drove 1,000 miles per month, let's say that month you drove 1,000 miles, let's say all 1,000 of them was business related. This is just for good math. If they give you 50 cents per mile that you drive, that's $500 in a tax deduction that you get every single month. You add that up over the course of a year, that's $6,000 in tax deductions just off of the miles you drove, as long as you were doing business or connecting it to business. So that's important, because $6,000 in the form of a tax deduction, now you wrote off some of the miles that you were going to drive anyway. But if you don't have a business, or if you're not marketing your business, guess what? You draw the miles and put wear and tear on your car with no ability to write it off and lower your tax liability. The other option is actual car expenses, and that's centered around expenses such as maintenance, car wash, tires, things of that nature. It's a list of things, and I'll go into that in more detail. But you want to take the one that's going to give you the biggest bang for your buck. So if you don't drive a whole lot, then actual car expenses might work out for you. We found that the biggest one is going to be that standard mileage rate. We've gotten the best, and we've been in my income for 7 years. We've gotten the best tax deduction, the highest amount based on the standard mileage rate, because our car expenses didn't have anything on the amount of miles that we were driving. So in this example, and this was based on the year 2020, the standard mileage rate for 2020, the standard mileage rate for the cost of operating your car for business use is 57.5 cents. My example was 50 cents. So it actually would be more than $500 a month, because it's 57 cents a mile based on the year 2020. Now, you don't have to remember this. You don't have to commit this to memory. It's just good to know that every 2 miles you drive, it's $1 tax deduction. Just pretty much, if you just sum it all up, every 2 miles you drive for business is $1 worth of tax deduction, which adds up when you're talking about 12,000 miles per year. So just make sure you understand that. So when you're keeping your records and you turn it into your tax specialist, they know what the rate is. They know, what it entails in order for you to maximize that tax deduction. Now, this second part right here is getting into the expenses associated with the car. So that's the standard mileage. This right here is dealing with the expenses. So you have interest. If you are an employee, you can't deduct any interest paid on a car loan. This applies even if you use your car 100% for business as an employee. However, whenever they say however in the IRS documentation, that means, it's an opportunity for me to save some money, because they'll say you can't do something and some people just stop there. But when they say however, just know that it's probably some good news or some light at the end of the tunnel. However, if you are self-employed and use your car in your business, you can deduct that part of interest expense that represents your business use of the car. For example, if you use your car 60% for business, you can deduct 60% of the interest on the Schedule C Form 1040. You can't deduct the part of interest expense that represents your personal use of the car. So you just have to know about how much you're using it for business and base it on that. Now, this is 60% of the interest, not the car payments, the interest, which is one of the reasons why I prefer the mileage opposed to the interest, because typically a person is not paying too much in interest. And if you're doing 60% of that interest, depending on how often you work your business, that number might be substantially lower than the amount of miles you drove. But this is just the example that you can write off interest if you're self-employed. When you with my econ, if you're working a business, you're automatically a sole proprietor, because you have a social security number in America. If you have a social security number, you are already in position to be a business owner from birth. As soon as you got a social security card, you became an entity, a business entity. We just don't know that. But since you now know that, now the fact that you have a MyEcon membership, you're in position to be a sole proprietorship. Now, if you want to go and really go big and do certain things and you want to consider LLC, then that's something you can do futuristically. However, it's a lot of opportunity being a sole proprietorship. So let's talk a little bit more about the actual car expenses. Here we have parking fees and tolls. In addition to using the standard mileage rate, you can deduct any business-related parking fees and tolls. So this is something you can do in addition to claiming mileage. This is not an either or. So you can be taking mileage and claiming your parking fees and tolls, which depending on where you live at, this can pretty much add up. So you can deduct any business-related parking fees and tolls. Parking fees you pay to park your car at your place of work, or non-deductible commuting expenses. So this is something that's in addition, which is why you just want to record everything. If you're in doubt, record it. If you are in doubt, still log in that expense, because you might think, okay, I can only do mileage, and you pay a parking fee and think, that ain't tax deductible because of the mileage angle. No, record it anyway. If you're in doubt, record it anyway and let your tax specialist figure it out. That's why you're paying them anyway. Actual car expenses. All right, so here are a list of some actual car expenses. In fact, I believe that the interest that I shared is in addition to the standard mileage as well. But, so record it. Just make sure you're recording everything. All right, actual car expenses. If you don't use the standard mileage right now, remember it's either or. So if you're not using the standard mileage rate, you may be able to deduct your actual car expenses. So choose what you think is going to be the biggest benefit for you. For us, standard mileage rate, for many that we know, is going to be the mileage, but I still want you to know of both. Tip, if you qualify to use both methods, you may want to figure your deduction both ways to see which gives you a larger deduction. This is the IRS telling you to use which one gives you the largest deduction. So don't demonize the IRS, because that's what the nuggets are. You say they say if you want to hide something from a person, you put it in a book, or you put it in some type of long content in the form of IRS documentation and statutes, etc. Then a person is hidden from the person, but it's actually in plain sight. The IRS is telling you what to do to qualify you for a larger deduction. They didn't say take the smallest deduction possible. No, they said you compare both to see which gives you a larger deduction. I can't make it any plainer than that. Actual car expenses include depreciation, licenses, gas, oil, tolls, lease payments, insurance, garage rent, parking fees, registration fees, repairs, and tires. Now, for some people, this may add up to more than what they drive per year. So do the math. You might want to calculate both, like they said, and see which one is going to give you the bigger bang for your buck. So in the example I gave earlier, it would have been $6,000 in mileage deductions. But if all of your stuff right here add up to more than $6,000, then, record both, but hand it out to your tax specialist so they can say, hey, yeah, you're going to benefit off of expenses more. And there's some other things that go along with it, because once you claim car expenses, it used to be to where you couldn't just go back to claiming mileage later. It used to be that you were locked in, but if you claim mileage right off the rip, you can always go back to claiming expenses. Get with your tax specialist to see what the rule is now, but that's how it used to be. All right, business and personal use. So, okay, let's go into this. If you have fully depreciated a car that you still use in your business, you can continue to claim your other actual car expenses. So basically, if depreciation only lasts for a certain amount of years, if you fully depreciated it, then you can just go back to all of the other car expenses that are in the list. So business and personal use. If you use your car for both expenses and personal purposes, you must divide your expenses between the business and personal use. Basically, they want to know that what you're doing is business related or personal related, because we know that, you're not going to use your car for business 100% of the time, unless you're specifically using one vehicle versus another. So in other words, when it's time to file taxes, what they want to know is, do you have a separate vehicle that you're using for personal use? So if not, then by all means, they want to separate between what's business and personal, and that'll be up to your discretion. So that being said, example, you're a contractor and drive your car 20,000 miles during the year, 12,000 miles for business use and 8,000 miles for personal use. You can claim 60%. So that's 60%, 20,000 is 60% in comparison to the 12,000 of the cost of operating your car is a business expense. And even in this example, the IRS gave you the bigger number. So they're trying to let you know that you can legitimately write off a lot of stuff. So let's transition from the car and talk about travel. And any question that you have, write it down and we'll get to it towards the end. But I just want you to understand what exists and understand that your role is not to memorize these, it's to understand, to record these. That's all you have to get good at, putting the numbers in. Once you put the numbers in, you hand it to the tax specialist free and clear, as long as you're operating your business, somebody can pay you some deposits. Travel. If you temporarily travel away from your tax home, you can use this chapter to determine if you have deductible travel expenses. This chapter discusses traveling away from home, temporary assignment, what travel expenses are deductible. So, travel expenses defined. All right. For tax purposes, travel expenses are the ordinary and necessary expenses of traveling away from home for your business, profession, or job. An ordinary expense is one that is a common and accepted in your trade of business. We're in the business of online marketing, network marketing, finances, education, online, credit, all of those things. So it's not uncommon for a person to travel for some type of training. It's not uncommon for a person to meet and sit down with someone. It's not uncommon for a person to travel in order to expand their business into another city or location. That's not uncommon in our industry, which is why you want to record everything and then determine on the back end if it's able to be recorded or accepted or not. But when they say ordinary and common, they're just saying based on the industry that you're in, is it ordinary for you to do certain things? I'll give you a quick example. We operate in all 50 states. So you can be expanding your business no matter what state you're going to. Yeah, you might have had family there, but you really wanted to go and expand your business as well while you were there, which makes a strong percentage of your business travel tax deductible. However, if a person had a barbershop solely, If they had a barbershop solely or a beauty shop solely, it wouldn't make sense from a record keeping standpoint for them to say they was out in Florida. If they live in Georgia, they was out in Florida trying to market their haircutting services or their beautician services. It wouldn't quite make sense because they're like, why are you in Florida if you got a physical shop right here in Atlanta or right here in Little Rock, or depending on where you're at? It wouldn't make sense. So that's what they mean if it's ordinary and common for that particular trade or that particular industry. So understand that with our business, we can operate anywhere, which increases the amount of tax deductions that we're able to get. Traveling away from home. You're traveling away from home if your duties require you to be away from the general area of your tax home, defined later, substantially longer than an ordinary day's work. Also, if you need to sleep or rest or meet the demands of your work while away from home. So for example, we just recently came from a training last month in Atlanta, tax deductible, 100%, because we had to be away, had to spend a night somewhere in order for us to fulfill that engagement, which was our business, pre-planned, etc. So it's not hard to be traveling away from home for business. Also, it says the rest requirement isn't satisfied by merely napping in your car. You don't have to be away from your tax home for a whole day or from dusk to dawn, as long as your relief from duty is long enough to get necessary sleep or rest. So don't worry about that as much, because I don't want you to commit any of this to memory. If you're traveling and you know you're going to do some business to try to grow your business and get some MyEcon deposit, record it and let the tax specialist handle that based on their expertise. Let the expert be the expert. Travel expenses you can deduct. I won't even go into this all the way, but I just want you to get familiar with it. And I got a lot more to share, but I'm gonna just read the head points. Transportation, taxes, commuter bus, airport, limousine, baggage, shipping, car, lodging and meals. So that's hotel, all of that. Cleaning, if you're doing laundry, all of that. Telephone, business calls, etc. Tips you pay for any expenses in this chart. So tips, you're able to even write that off, and then other. And then it's just other things centered around what may be applicable to your business type. Other similar, ordinary, and necessary expenses related to your business travel. These expenses might include transportation to and from a business meal, public stenographer fees, computer rental fees, operating and maintaining a house trailer, just depending on your industry. But just know that these categories, it's a lot of things that you can write off based on your travel. So record everything and then let the experts be the experts. Next, let's talk about meals and entertainment. And before I go into this is important. This is very important. Yes. We got a quarter of the year left. You already know where I'm finna go, don't you?
Yes. Do you want me to read that first or do you want to go ahead?
Yeah, I'm gonna say what I'm gonna say. You can feel free to read. But
okay.
This just came across my desk last week, and this is powerful because the IRS, it's a lot of different things going out there, pandemic related, etc. But the IRS made it so that if you are self-employed, it used to be the meals that you claim is 50% tax deductible. So you'll see that right here. You can continue to deduct 50%. It used to be that you can deduct 50%. Mm-hmm. However, for this year, 2021, as well as all of 2022, all the way to December 31st, into the ball drop, you're able to write off 100% of your meals if you're self-employed.
Drop some hand claps in the comments.
100%.
Yes.
If you're self-employed. And I should have had that documentation, because the main stipulation they said is you must be present when ordering the food. You know what I'm saying? Or you must be the one paying for the food, ordering the food. So that's the only obligation. So many people eat out. Many people dine out, many people, drive through, pick up meals, 100% tax deductible. Why is that important? Because now you just made some of the things in restaurants and things that you were gonna do as a business owner, as a self-employed individual, 100% tax deductible. That should get you excited, because I know it's a lot of people who eat out. The world is opening up, people are eating out like crazy. Okay, at least make it beneficial. So that's why it's important. That's another reason why you wanna strongly consider building the business side of things, because the more cash flow you have, the more cash flow you can put towards that, which helps you elevate your credit. The more cash flow you have, the more cash flow you can put towards investing, which helps to elevate your wealth. So I know sometimes people say, well, I just want to do the credit. That's cool. And it's no pressure. However, I can almost guarantee that you're going to leave $10,000 plus in tax deductions on the table, especially when you calculate 100% in meals and entertainment. Now, did you want to read in on this? All right, perfect. So
You brushed on it.
okay, so I just wanted to lay that out. Now, it says you can no longer take the deduction for any expense related to activities generally considered entertainment, amusement, and recreation. Now, if your meals included some type of entertainment, I say this, record it, because I've heard mixed information. Let your tax specialist tell you if the entertainment is obsolete, because I've heard mixed information. At first, they took it off, then they brought it back because it just made sense to do so. And plus, a lot of wealthy people was losing money because they'll do a yacht party or something golf related, and they weren't able to write it out. So, they got with the politicians and they got shifted. So if you're doing something entertainment related, that also includes a meal, record it as well, as long as you're connecting it to business. But the meals, are definitely 100% tax deductible. So just understand that you can write off some meals as well. I won't spend too much time on that. You know what meals are. Of course, they want you to be doing business related things, but the document didn't say that you even have to be doing business. This was just a pandemic release thing. Look, if you're a self-employed individual, we know that a part of your daily life is going to consume of you eating. You get 100% tax deduction. So that's why it's important to get some MyEcon deposits rolling in as soon as possible. If you make over $600 in MyEcon within a year's amount of time, MyEcon gonna send you a 1099, which is extra proof. That's extra proof that you're working a business. When MyEcon sends you a 1099, that's extra proof that you're working a business. Not to say that if you made $500, that's not proof, because you'll be able to show based on certain content you post, videos, trainings, your membership fee the $39.95 a month, all of that, you want to be writing that out. So you'll be able to show and prove that. But you'll elevate and escalate over time to a point where you want to make sure every year MyEcon has a reason to send you a 1099 as well, because it'll position you to have a ton of tax deductions. All right, let's go into the interest. As you can see, there's more stuff on here. I want to keep it plain because we've got a lot to cover, and I've already taken a decent amount of time, and I still got a lot more to go. So interest, you generally can deduct as a business expense some or all of the interest you pay or accrue during the tax year on debts related to your business. Interest relates to your business if you use the proceeds of the loan for business expense. So this is talking about interest pertaining to loans that go towards your business. So if you have that, make sure you record that as well. Now, this is an introduction to wages. This is an introduction to wages. So basically, it's talking about you paying employees. Now, in MyEcon, you don't have employees, but I want to transition to this next section because this is important. You may not have regular employees, however, you have family members who may possibly be able to help you. For example, we were talking to a queen earlier, Miss Carter, I'll just say that. And she was talking about how it was certain things she wanted to know. And she said, I'm gonna get my kid to help me. That means that the children may be tech savvy. So the fact that they're helping you out with your social media, helping you out with certain things around the house that pertain to your business, helping you do certain things, guess what? They can possibly qualify as family employees. And it changes every year, but I believe you get up to $12,000 in a tax deduction that you can pay them. That has to make sense, but you're already spending money on them anyway. So if you're spending money on them anyway, if you do it right, you can make it so that you're paying them a certain amount, and then that certain amount can go towards whatever you was going to pay anyway. If you're going to buy clothes, don't just buy the clothes, pay them $300, and now they spend the $300 on the clothes. You wrote off the $300, they bought the clothes with the $300. So that's just an example. Again, not tax advice, just want to let you know that you may have some family members or some children that you're able to pay legally, lower your tax liability, without having to go through all of the stipulations of actually hiring an employee. So I'll read this briefly, but that's the gist. Payments for the services of a child under the age of 18 who works for his or her parent in trade or business aren't subject to Social Security or Medicare taxes. So in other words, they don't have to pay these taxes if they're hired by you. If the trade or business is a sole proprietorship or partnership in which each partner is a parent of the child. Notice, they talking about sole proprietorship. So it's some things that you can do as a sole proprietorship that you got to do something different if it was an LLC. Sometimes people are so quick to want to do an LLC, which is not bad. I get it, but it's certain things that you are able to do more of as a sole proprietorship. If these payments are for work other than in a trade or business, such as domestic work in the parent's private home, they're not subject to Social Security and Medicare taxes until the child reaches age of 21. So it's a lot of tax deductions, especially if you have younger children. However, later, payments for the services of a child under the age of 21 who works for his or her parent, whether or not in a trade or business aren't subject to feudal tax. So less taxes you have to worry about, long story short. Payments for the service of a child of any age who works for his or her parent are generally subject to income tax withholding unless the payments are for domestic work in the parent's home or unless the payments are for work other than in a trade or business and are less than $50 in a quarter or the child isn't regularly employed to do such work. In other words, you being a parent, you're minimized of a lot of different taxes that if they were being paid elsewhere, they would be subject to certain things. So some incentives for you hiring your child. The IRS is trying to position you to be a owner, to be an employer, not just an employee, even if that means your children are helping out with the family business. Business use of your home. So this is talking about business deductions as it relates to your home, because there's certain things that you can do in the area of using your home for business. I don't want to go too deep into this, but basically, it's certain things that you'll be able to write off as it pertains to your home. I'm trying to find like the bullet points of it so you can just get a gist of it. Principal place where you can have more than one business location. It's something specific. I'm looking for regular business particular. All right, we're gonna skip on. We're gonna skip on that. We're gonna skip over that part. But just understand that there's certain things pertaining to your home. In brief, it's certain expenses that you want to record, such as internet, such as certain utilities. Record those things and get in the habit of it, so that way that you'll be in position to have it when it's time to file it at the end of the year. And I'll give you another example that goes a little bit in depth to give you a broader example. This is a lot of jargon that I don't want to confuse you with. I just want you to get, if nothing else, record keeping in your head. Don't worry about all of the details of the IRS. Get record keeping in your head. You see gifts. You have the ability to write off certain percentages of gifts. You can deduct no more than $25. So I won't spend too much time on that, but gifts fall into the common tax deduction. Depreciation of certain business related assets fall into this category as well. So, and repairs and things of that nature. So if you're using like your computer, your phone, it's a lot of things that fall into the depreciation category. Self-employed health insurance deduction. If you're paying for your own insurance and you're self-employed, you get to write that off 100% as well. And then how to prove expenses. So basically, records. You should keep proof you need in an account book, diary log, statement of expense, trip sheet, similar records. MyEcon got you taken care of. We got the cash flow manager. It's IRS qualified for record keeping. So we don't have to go into that. Cash flow manager is what you want to get familiar with, because that's how you prove expenses. You must be able to prove the elements listed across the top portion of the chart. You prove them by having the information and receipts where needed for the expenses listed in the first column. If you're using the cash flow manager and you're using your phone, you're able to take pictures of your receipt, upload it into the system with other detailed information, and your record keeping is good to go. Record keeping is flawless. You're able to have that and recover it if need be. So they're talking more about the records, but the cash flow manager has you covered on that, and I'll give you a decent example. Other common expenses. Now, this is one you want to screenshot or write down, all 13 of these, because these are just some that might not have got covered. But I already told you the MyEcon fees. You shouldn't be paying your MyEcon bill 100% without it being 100% tax deductible. This makes your business free. You just sharing the information and getting some MyEcon deposits makes your $39 free. Sometimes people think of it as a bill. No, this is an asset. We told you that from the beginning. This is an asset. Why? Because it shows you how to increase your cash flow, bring in more money. If you work a job, you really have the opportunity to bring in more money. Shows you how to better your credit, lower your interest rate. Shows you how to get out of debt faster, save on interest. And it's showing you how this stuff can be tax deductible. So this is an asset. MyEcon fees, tax deductible. Bank fees, tax deductible. Tax preparation fees, supplies, business education, which includes seminars, training. Literally, if MyEcon is doing something and it costs money, don't shy away from it, because that's 100% tax deductible, because you're educating yourself. It's like continued education for any trade that you may have. Those are tax deductions. Retirement investments. If you understand some of these, IRAs, simple IRAs, sometimes 401ks can be tax deductible as well. Smartphone service. Everybody got a phone. You're probably tuned in right now using a phone. Tax deductible. And the more you do business on your phone, whether you're creating marketing material, posting, doing videos, all of the things that we do, it's not just to keep you busy, not just to have you doing something for nothing. No, If you're using your phone, whether you're on TikTok, IG, Facebook, whatever platform, if you're using your phone to build your business, that qualifies your phone to be tax deductible. Too many people pay 100% of their bill when a strong percentage of it could be tax deductible. Internet access, everybody has that. Printing, webinar fees, business mailbox fees, legal fees, advertising, 100% tax deductible. And many of the things on this list can be up to 100% tax deductible. All right. So it talks a little about deducting business expenses, which we, I don't want to be the dead horse and continue to talk about that. But the fact of the matter is, if you got nothing else, understand what those tax deductions are so you can record them. Now, I got a lot of things I'm about to bang out, so excuse me for talking fast. However, I'm about to bang them out real quick and then open it up for questions, and the recording will be available. So I want you to know what your number one asset is. I want y'all to guess what you think your number one asset is. Type that in the chat. What do you think your number one asset is? And if you were listening close to what I was just going over with the tax deductions, you should know what your number one asset is. But let's dive into it. And let me do this in present mode so to get big on us real quick. Let's get big real quick. Oh, can I move this? All right, there we go. Perfect. Okay, perfect. Let me move this out the way. I know y'all can't see it. All right, so your number one asset. Now, this is an example of how it looks when you're keeping your records. So you see 1 through 11, you got mortgage, utility, cell phone bill, mileage, meals and entertainment, internet, and then it'll give you a total deductions. It'll let you know how much, of a percentage you actually get to claim, business income, total income, other options. And I'm gonna break that down step by step because it's gonna be literally a fill in the blank. Now, for a person's mortgage, let's say they're writing off a percentage of their interest and it's $200 a month for a total of $2,400 a year. Utilities, let's say they're writing off a portion of their utilities, 20% in this example, because they're using 20% of their home to operate their business. $100 a month, $1,200 for the year in tax deductions off of mortgage and utilities, money that we're going to be spending anyway. Cell phone bill, let's say that they're doing 85% of the business from their cell phone and they're able to write off $85 of a $100 bill. That's $1,020 for the year. And you can see what the total amount was right next to it. And then the percentage represents how much of that they're writing off based on their business use. And then you'll see what it is on a monthly basis and on a yearly basis. Then mileage. Let's say a person drives 10,000 miles, and let's just say that the mileage rate was 56 cents. For 2020, it was 57 cents. So this number fluctuates. We've seen 51, we've seen 53, we've seen 57. In this example, it's 56 cents. Now that doesn't show a monthly amount, but on average, 10,000 a mile, 10,000 miles for the year, 56 cents per mile will total up to $5,600. This is what I meant when I said a lot of people will leave $6,000 in tax deductions just off of their car alone by not building the business. Meals and entertainment. So let's say you spent $200. In this example, it's 50% of that because you could typically just write off 50%. We can scratch that out and make that 100 for this year as well as all of 2022. That would be $100 a month, really more based on that new rule, and then $1,200 for the year. Internet, let's say you're paying $50 and you get to write off 100% of that internet, $50 a month, $600 a year. And a lot of this is stuff you're already spending money on anyway. So a total deduction, when you add up the yearly deductions, you're able to deduct $12,020. And this is just 6 different things. We didn't include the MyEcon fee. We didn't include travel is not even on here. So this is just, some brief examples. Now, you're not writing this off dollar for dollar. Say you write off $12,000. It may not lower your tax liability by a whole $12,000. It may be a percentage of that. So that's what this 30% represents. So say you had $12,000 in deductions. It may lower your tax liability by $3,600, which can be pretty significant. That's like carrying a kid on your tax deductions. Then let's just say you earn some business income. Let's say you earn $2,400 in the business. Just basically $200 a month. You earn $200 a month in the business. So if you look at the tax incentive of how you was able to lower your tax liability plus the business income, that's an extra $6,000 that you were able to cash flow back into your household. $6,000. Now, this represents what it would take to get $6,000 elsewhere. If you're putting your money in a bank In order to get $6,000 in cash flow, you would have to have 600,000 sitting in there that's paying you at 1%. If you were putting your money somewhere else that was earning you 3%, let's just say there's a municipal bond fund or something, you would have to have $200,000 in there in order for it to pay you $6,000 for a year. If you're putting it in an account that's earning you 6%, and these are low numbers, but you would have to have $100,000 in order for it to pay you $6,000. So the point of this is, if you have a business and you're writing off tax deductions, that $6,000 in cash flow is pretty significant when you compare it to those other options. Now, $6,000 basically represents the cash flow that you were able to create. But at the beginning, I told you I wanted you to make note of what you think your number one asset is. And it's not showing it on here. So let me exit full screen so you can see. But right here at the bottom, it says your business is your number one asset. Strategize your way to wealth. You see, wealthy people talk a lot about tax deductions. The reason being is because the more they lower their tax liability, the wealthier they get. We have to think like them, no matter what level we're on, whether we're working a job, whether we're self-employed, unemployed, or, you know, a mixture of the two. We have to make sure that we are thinking and strategizing our way to wealth. And our business is our number one asset, because you can get an unlimited rate of return just by being in business if you understand how it all works. Now, I was going to go in deeper detail, but I want you to get familiar with the cash flow manager. So that's going to be homework, and that may turn into another training, but this is an example of the cash flow manager. And basically I'll do one example. Let's just do the $39.95 monthly of my econ fee. So this is an example, and it looks totally different from the phone, but monthly renewal fee. So I want to show you how to log this in. So it has different categories that you're able to scroll down and see which expense is applicable based on what you're about to log. You put in the date. Today's date is the 20th, but if you got started last month, last week, you put it in based on that date. In this example, we're claiming the monthly expense, the my econ fee, and that's $39.95. So you put the amount. Who represents who you paid it to? Paid it to my econ. What you paid? It was your monthly membership fee, a monthly business fee, or a monthly, online membership fee, whatever you want to title it. But in this example, monthly membership fee, monthly business fee. That's what. So the who is where you spent the money to, who you spent the money to. What is what makes this tax deductible? Basically, that's what you want to be asking yourself. What makes this tax deductible? If it's business related, it's tax deductible. So you can put monthly business fee, monthly website fee, something that represents a business deduction where this transaction happened online. Then you can make some other notes. Sometimes it might be dealing with a meeting or, whatever the case may be. We use all different types of stuff. And on your cell phone, you'll be able to choose file or take a picture. And now you're able to either do a screenshot. When you hit choose file, you can grab a screenshot of the $39.95 that you spent. If you had a printed off receipt, it'll allow you to open up your camera and take a physical picture of that receipt. If it was miles associated with that travel, you would be able to put in either your estimated odometer reading beginning and ending, or you can just plug in miles. If it was an estimate, okay, round trip probably did about 32 miles. You can just plug that in for your notes. So that way it's tallying up throughout the year and it's associated with whatever that expense was. Now, of course, you wouldn't put any miles for a transaction that happened online, but I just wanted you to see that. And then with the monthly my econ fee, right here has that section that says recurring. Yeah, this recurs monthly. So now when you log back into the system and then say with the next entry recurring on, and if today is the 20th, we'll say that the next one is going to be November 20th. So now, instead of you having to do this every single month, when you log back into your cash flow manager, it's just going to ask you to accept it. Would you like to accept this monthly membership fee? You just say accept. That's it. Because it's a monthly recurring fee. So you're not having to do that every single month for this expense. So I just wanted to give you that one example, but it's based on all of your, your expenses associated with your business. And that is what allows you to lower your tax liability. More cash flow into your pocket helps you better your credit score because you can pay off debt sooner. Paying down your debt, especially your credit cards, etc., allows you to boost your credit score from an income shifting standpoint. So understand the power in that. Now, I also want to talk to you about tax deductions and how they can help you build wealth. And I'm going to close out with this. I know it's at the top of the hour, and I just bought myself some time because I was going to do a little bit more on that cash flow manager. However, I want these trainings to be worth your time. I want you to feel like you paid for this at the end of the night, because I know that this can put money in your pocket. Anytime you come to a training, it's something that's going to be said that could put money into your pocket. So what I want to speak on now is centered around just investments. Every now and then we're going to do a little crypto talk, because I feel it is mandatory that we start understanding investment. We're going to talk about ETFs as well. ETFs is my preferred method of training for a new person, so they can make sure that they're investing without the risk, especially if you're not sitting there watching the stock market all day long. You want to invest in an industry that you feel has a future. However, we have to familiarize ourselves with crypto. Some of you may already be familiar, so I may be preaching to the choir, but I know a lot of you not, because the percentage of adoption is still haven't reached a percentage of what it would be futuristically. But if we're not even hearing this conversation and positioning ourselves, then we're going to be at a loss from the beginning. And I don't want that to be anybody in the royalty movement. I'm also going to put the links that I shared in there last week, so you can get an understanding of setting up your account. If you have not already set up your Coinbase account, I want you to click the link, use the link below. It says try crypto. Basically, that'll be your Coinbase account. So give me a second while I type these up. This is going to be your Coinbase account. That's the main account, or the most common account that people use as it relates to buying and selling and transferring crypto. So you want to have your Coinbase account. Another account that I like is Qcoin, and I'm gonna put the link for that as well. If you have not set those accounts up, please do. I may do a training that shows how to set it up, because you're gonna have to approve certain deposits and connect your ability to pay. But I want you to get these, because there's gonna be some future trainings that I'm gonna want you to already have these accounts. And sometimes you really want to have these accounts, because each training I may give you 1 or 2 cryptos to consider looking into, because I think it's on the front end. I like to talk about cryptos that's not being talked about, because it positions you to maximize your profits. Let me know if that link is those links are clickable. It looked like it may not be, so I'm gonna type it in a way that it's clickable, because I don't think it is. Let me see. Some people may be able to click it, others may not. So this should make it to where everybody is able to click it. All right, boom, we in there. So the reason why you want to have these accounts set up, because if I share something that you are in a position to invest in, you never know what that investment can turn into. So whenever I'm looking up a crypto, I go to coinmarketcap.com. I'm gonna give you 2 that I want you to consider. Especially with us being in my econ, we got to understand where finances is going, because things are changing. Banks are at the edge of their seats. The government and certain things are at the edge of their seats, because people are shifting their energy into other areas, and crypto and the blockchain is a key part of that. So this first one I'm going to show you is centered around fintech. Fintech is just financial technology. It's the new wave of where money is going, where finances is going. And you want to be on the forefront of this type of information, and you want to be invested in the future of it, because when it heads that way, you're already in position. You don't want to be the last person on the ship as it relates to this. So this fintech one is something that I was going to share last week, but time got away and I was like, okay, I won't share it. But I had already invested in it, and it had produced like a 200 to 300% rate of return in a matter of a week. Now, crypto is volatile. It can go up, it can go down, it can do the 300%, then go back to where it looked like you at a loss. But if you believe in the industry itself, then it doesn't matter, because you can be in it for the long haul, not trying to get a quick flip, or having the fear of missing out, or scared to lose money. If you believe in the future of it, so that's why it's important for you to do your due diligence. But this particular crypto that's in the fintech space is called Apollo Currency. Apollo Currency. Look into it. This is the site. And basically, if you want to click on the site at any time you're on CoinMarketCap and you're looking up a crypto, that first link right there will take you to that site. So if you can see where my cursor is right here, that'll take you to that site. So you can look more into it, play the video. I don't think I can play the video out loud where you can understand it. but it has a future ahead of it as it relates to what they're trying to do. They're opening up some markets in the Africa area, and sometimes other people adopt it earlier than the US. So it's going to be important for you to look into it and figure out what problems they solve. So I want you to look into this and what it is that they're doing, because they coin themselves as the fastest blockchain. And if you know anything about crypto, speed used to be an issue. So they're saying they're going to be one of the fastest ways to make payments. They're helping people in the area of these features that are listed here, which you'll have to look more into. I'm not going to go in depth. This is just homework for you if you're interested in the crypto world, because I think it's important. And if you see, the price of this coin is less than a penny. So even if you just get a position and just at least buy a certain amount, just see what it do. Make sure you invest in money that you don't care about losing. You can have a lot of it for a little bit because it's less than a penny. However, it's certain ones like this that have been less than a penny that have created millionaires. They've been less than a penny that have created people who are, have over $100,000. Sometimes, multi-millionaires. So just understand, don't look at the number. This just means you're early. In many cases, you're just early to the party. And if it grows to become something, if it grows to a penny, you're in profit. So just understand the power in there, but look into it and play that video, watch the video and see if you like anything that you hear. But this is the future of finances, fintech in a sense. Now, the other one I want you to look into, because you got to think, when we're talking econ, cash flow, income shifting, you want to be putting that money towards something, eliminate that, investing, etc. The other one I want you to look into is called TrueFi. And this one just spelled it wrong. This one just came across my desk like yesterday, but I looked into it. I'm like, uh-oh, they may have a potential. And this one is 60 cents. So it costs 60 cents per share, so consider investing whatever you feel, if you feel like it is something that has a future. And I'll read a little bit about this. And this says introducing TrueFi. DeFi is basically decentralized finance. And so getting out of the banks, basically. That's really what it is. But DeFi is first uncollateralized lending protocol powered by on-chain credit scores. That's why I want us to look into this, because we are in the area where we're talking about credit all the time. We're talking about debt elimination. We're talking about investing. That's personal finance. This could be what the future of personal finance looks like, because they're positioning people to loan out their crypto and be the bank, earn interest for loaning out their crypto and be the bank, become the bank. However, if you understand this and you're invested in the coin itself, then as this industry grows, even if you're not lending out crypto or borrowing crypto, you're profiting from the fact that everybody else is. So in a nutshell, I feel like it's important for us to understand this, because they're creating one of the first protocols that allows a person to have a credit score. And I'll read this paragraph right here. It says, while much of DeFi success has been built on over-collateralized lending, uncollateralized lending, and bringing true credit scoring to crypto is widely seen as the next transformative step for DeFi. The traditional unsecured lending market makes up to 11 trillion global industry, yet none of that lending had come on chain until TrueFi completed DeFi's first uncollateralized loan in 2020. So it just came out in 2020, but it's important because it's a lot of money that's being transferred, shipped around, shared, borrowed, and there's no real way to keep a person truthful. So what they've done is created some technology, also known as a protocol on the back end, that can verify certain people or certain wallets as being trustworthy. Very similar to the credit system. They want to know if you have credibility. And if you do have credibility, you're able to qualify for a lower interest rate, things of that nature. So this is something we want to make note of, because even though this may not fully manifest 5 years from now, but if you're already in position, you already have some ownership in some of this crypto, 5 years from now, that could, be a pretty penny. That may be an early retirement move for you. Who knows? But I just want you to be aware of it, because that's what the royalty movement is all about, exposing you to things early on the front end, behind the scenes, that we can't talk about or won't talk about, or probably won't talk about just publicly. We want you to be on the inside of things. So those are the two cryptos I want you to look into as homework. Basically, the Apollo, which is APL, that's the symbol, and TrueFi, TrueFi, because they're in the financial realm, which my econ is in the financial realm, but this is on a blockchain crypto area. It's a lot going on in the blockchain. It's a whole nother wild, wild west. And I'm still learning and navigating, but what I learn and navigate, and typically when I find something, I tend to kind of be ahead of my time. So I don't know how far ahead of my time I am, but either way, I want to share these things with you because I would love for you to reap some of the fruit of my research as well. So that's it in a nutshell as it relates to the training. We're going to open up for feedback, for comments, for questions. Main thing is I wanted you to understand the common tax deductions, which we went over pretty thoroughly. And it's not for you to memorize these common tax deductions. You just want to hear about them on a regular enough basis because you might realize, oh, I ain't know I can write that off. I ain't know I can write that off because there's been certain trainings that we've attended and realized that we can write off certain things and it might have saved us $5,000 on our taxes or lowered our tax liability by a few $1,000s, all because we were on training. So you were here, you were attentive, you stuck around. This may lower your tax liability. We still got 90 days. So it's some stuff that you might have didn't claim last month that you need to claim. Earlier this year that you need to claim because how the government looks at it is that you were in business in 2021. Yeah, you might have started in October, September. They're looking at it like you're in business in 2021. So it's certain things that you might be able to still be able to claim due to it still being 2021, just a little nugget. And then we talked about those tax deductions rolling over to being your number one asset. Got you a glimpse of what that looks like, how it lowers your tax liability, and understand the power of your business because it helps you strategize your way to wealth. We logged in the cash flow manager, your monthly renewal fees. I was going to do a few more, but we got more trainers to come and some in the back office as well. Just want you to understand that your main goal and focus is the record keeping. Don't memorize the tax deductions. We don't know them all and they change every year. So since they change every year, it don't matter. Just record what you know, because when you record it, now you hand it to the tax specialist. They supposed to be on top of what the new laws is. Absolutely. That's why they're getting the percentage that they get when they file your taxes. And if they're a good one, they'll let you know, hey, don't forget to record this and do this. They'll help you strategically lower your tax liability as well. Then we transition on how that cash flow can turn into some investment with an emphasis on crypto. Hopefully y'all got those links below. If you have not set up your Coinbase account using that link, do so as soon as possible. If you have not set up your KuCoin account, do so as soon as possible. And this TrueFi is available on Coinbase. Some things aren't available on Coinbase, so you got to do some other stuff, which I can show you how I navigate from Coinbase to KuCoin in a way that saves me some fees, etc. But you have to have the account set up so I can show you those things. I don't want to talk about it. I want to give you a little glimpse first, then we can actually do some practical things as well. All right, that's all I got. You got anything else you want to say before we open up for questions, Queen?
You guys go ahead and hang on if you have any questions. We're going to end the recording first, and then we'll take any questions, comments, feedback that you have.
Absolutely. So this concludes tonight's training for the recorded version until we talk to the kings and queens to see if they have any questions or feedback. Hope you enjoyed it. Replay whatever you need to replay. Take notes, then apply.